May 29th gave the market a different kind of growth signal. The indexes made more records, but the cleaner story was inside software. ServiceNow, Oracle, Microsoft, Salesforce, Palo Alto, and Palantir all caught a bid. After months of trading like AI might eat the sector, software finally looked like it was being invited back into the rally.
The index numbers were positive, but they were not explosive. The S&P 500 rose 0.2% to 7,580.62. The Dow gained 0.7% to 51,032.46. The Nasdaq added 0.2% to 26,972.62. All three closed at records, but the Russell 2000 fell 0.6%. That tells you the day was not simple risk on everywhere. Leadership still mattered. The software move was hard to ignore. By the close, the IGV software ETF was up about 6.25%. ServiceNow rose about 14.4%, Oracle about 10.8%, Salesforce about 8.5%, Palantir about 9.2%, Palo Alto about 9.3%, and Microsoft about 5.5%. This was more than one earnings gap. It was a sector trying to reprice. Snowflake lit the fuse earlier in the week. The company reported $1.33 billion of product revenue, up 34% year over year. Snowflake also raised full-year guidance and expanded its AWS relationship through a new $6 billion multi-year agreement. That gave investors a concrete reason to ask whether AI is hurting software or making the stronger platforms more useful. This is the important shift. The bearish software story was that AI agents would replace seats and make old SaaS workflows less valuable. The bullish answer is different. If companies use more AI, they still need data, permissions, observability, workflow control, and security. The market spent Friday paying for that second version of the story. The argument for higher spending is getting broader. Denise Chisholm argues that CapEx relative to sales is accelerating across all 11 sectors, not just technology. She also notes that S&P 500 aggregate CapEx to free cash flow remains below 1.0, compared with the 3.5 to 4.0 range near the 2000 bubble peak. That does not make the market cheap, but it suggests this cycle is more diffuse than the bear case says. Hardware still helped set the mood. Dell jumped 32.8% after the company delivered stronger profits and raised its outlook on demand for AI computing. But Dell was not the whole story today. The real question was whether the hardware boom can pull software platforms with it. For at least one session, the answer from the tape was yes. The problem is that software is still a long-duration trade. Earlier in May, the 30-year Treasury yield moved to roughly 5.2%, the highest level since 2007. That matters because higher long-term yields make future growth less valuable today. A software rally can start on better earning sentiment, but it needs rates to stop leaning against it. There is also a breadth warning to keep in mind. Patrick Boyle's read was that roughly 94% of recent S&P 500 gains came from a small group of tech giants, and much of the market outside AI was basically flat for the month. Treat that as a risk signal, not a law of physics. One strong software day is encouraging, but it is not a completed broadening of the market. The closing tape also had mechanical noise. One May 29th market read attributed late-day moves in NVIDIA and Intel to MSCI rebalancing and pension fund selling, rather than fresh fundamental news. That same rebalancing read said CoreWeave, SanDisk, and IREN saw buy pressure. Some of the day's moves were flow-driven. Flow can help a rally, but it can also exaggerate it. The next tests arrive fast. Broadcom reports on June 3rd, with expectations for $2.39 of earnings per share on $22 billion of revenue. Ciena follows on June 4th, with earnings expected to jump on AI data center demand. Then payrolls hit next Friday. If job growth drops under 100,000, the soft landing story gets more fragile. The confirmation list is practical from here. Watch whether the software ETF holds this move instead of giving it back. Watch whether Microsoft, Oracle, ServiceNow, and Salesforce keep leading after the first squeeze. Watch whether Broadcom and Ciena support the bridge from infrastructure to software. And watch rates. If yields climb again, software multiples will have to fight the bond market.
The takeaway from May 29 is not that every software stock is fixed. The door opened, that is all. The market stopped treating software as a pure AI victim and started pricing parts of the group as the next layer of the enterprise AI stack. That is a better setup than the sector had before. It still needs follow-through, calmer rates, and proof that the bid is broader than one hot Friday.